Welcome back to the Dividend Diplomats YouTube channel, everyone. Lanny, Bert, the Dividend Diplomats. Oh, I was going to get there in a second, but Lanny is rocking the Dividend Diplomats crew neck sweatshirt. So you know what? If you weren't happy with some of the Christmas gifts you got this year, you're going to be returning stuff. You're going to have some extra cash laying around, stop by the shop, which is below. You can see some of that Diplomat swag that we are bringing to you. But in all seriousness, everybody, in today's video, we are going to talk to you about an undervalued stock that has a pretty high yield that we are pumped up to feature today.
And if you haven't done so already, definitely smash that subscribe button. Give this video a thumbs up. We're still creating videos here through the holiday. We're doing this remotely just because of, again, the holiday. It's December 26th, and we are still filming. We are trying to pump out dividend investing content. We're getting close to the end of the year, and Bert is really eager to keep investing towards that final day. And he's got a nice undervalued stock that's hot on his radar.
That's absolutely right, Lanny, because just because we have a week left in 2021 doesn't mean that we are going to sit on our hands and watch the market go by. We are trying to buy up until the last second the market is closed at the end of the year, because we want to keep growing our dividend stock portfolio. And what's fun about this stock that we are going to feature today is I've been adding them to my wife's portfolio over the last few months as well. So as we continue buying, we continue running the metrics, it is still showing signs of undervaluation and could potentially be that big stock purchase we are going to make before the end of the year.
Now, before we dive into the stock, just keep in mind, we focus on 3 dividend stock metrics by using the patent pending Dividend Diplomat stock screener. 1, the price to earnings ratio less than the S&P 500. And we like to compare with the competitors within the industry. 2nd, a dividend payout ratio, brother. We like payout ratios below 60%, preferably in that sweet spot of 40 to 60%. Why? Because the safety in the dividend, but also the ability to grow the dividend, which is the 3rd dividend stock metric, dividend growth. We look at the growth rate on average over the last 5 years, as well as how long have they been doing it. And Bert, what's that bonus metric we take a look at?
Dividend yield, brother. So that's what we always look at. Every stock before we buy, we run them through the screener. We run plenty that we're going to put on our watch list through there. We are always running those 3 metrics as our entry-level screen to make sure we are comfortable with the stock that we are going to buy. That being said, Lanny, I think it's time. Should we announce the big company here?
Do the big unveil. The team is waiting, the community, the dividend investing community. And guys, for all that don't know, dividend investing is the best form of investing in our opinion, because it produces a nice form of passive income for you. And Bert, let her rip on this stock, because this stock does pay you a dividend quarterly, baby.
We need one of those like serving platters where it's like you have the plate and then you can pull the top off for the big reveal. So that company will do the figurative one is going to be Unilever, ticker symbol UL. That's right. We are going back into the consumer staple arena, everybody. One of my favorite ponds to swim in there. I love consumer staple stocks because you can find their products everywhere in your household. You can find a lot of their products in our bathroom. That's just a few rooms over. There are a lot of great things too. And it's also in your kitchen.
Exactly. This is a hot branded stock. Some of the brands just to mention for Unilever, you've got Dove, you have Axe. Bert loves his Vaseline, keeps it in his pocket at all times. You've got Degree deodorant. You got to love the Q-tips, making sure your ears are staying nice, fresh, and clean. Now, Bert, they did just sell a very big consumer segment. What did Unilever just decide to kind of sell off to a private equity group?
Yeah, they sold off their tea business for 4.5 billion euros, or about 5.1 billion US dollars. So yeah, gone. We used to love how they had Lipton, how they had Tazo, how they had all these other tea brands. See ya, get out of there. 34 brands out the window. That being said, they still have over 400 brands to their name there. So it's not as if they're just shaving off a huge portion of their company here. They're just getting rid of, some of those teas there. At nighttime, you're going to boil the water, just sip on a nice chamomile before you go to bed.
I tell you what, I mean, that was a decent, I'm sure a nice component of revenue. I'm sure a consistent cash flow. But hey, if they want to get out of the business, they get out of the business. And you know what they say? They say it doesn't matter. They say, hey, listen up, jabroni. And they're trying to say if you smell what Unilever is cooking, and hey, they're making moves right now. They're trying to bring in a nice influx of capital. I mean, 5 billion is nothing to scoff at.
No, that's a huge amount there for some legacy brands there. So it's exciting. They still have a lot of other food brands as well. They'll still have Ben & Jerry's, Pryor Ice Cream, Klondike, Popsicle, which my daughter was, and Knorr, one of their largest revenue generators there, along with Dove. So they still are keeping a lot of the big names. And too, Annie, I know you're worried because you have a ton of these jars in your cabinet. You still have plenty. They're keeping Hellman mayonnaise there for you. So when you mix it in with your coffee every morning, you're going to know.
Nice lump of mayo and that fresh brewed coffee.
Yeah, but in all seriousness, the reason why we love Unilever are the brands.
We do not recommend doing that.
No, yeah, the stamp up there that says "Do not follow," like but the brands are great. That's there. So let's dive into the results here before we go into the stock trading. Their last earnings release was in October, so just to run through it quickly. Q3, they showed 2.5% sales growth on a quarter-over-quarter basis, and then overall, their annual year-to-date sales growth are 4.4% compared to last year. I know I mentioned Dove is one of its largest brands. They had over $5 billion, or euros, I should say, of sales year-to-date, and Knorr $4 billion of sales year-to-date. Those are two of the largest. Again, they have massive, massive brands just to show their impact.
Wow. So you're talking like canned soup or soup and some canned goods plus soaps makes up almost 10 billion in euro or over 10 billion US dollars. It's nice to see that they're actually having some, it looks like, organic sales growth. So that's obviously positive, because what you hate to see is the no to negative growth on the consumer staple stocks. So, well, with them spinning off or selling the tea business, we'll have to see what the impact is, because I know the revenue it generated was a couple of $1 billion. So, we'll have to see if they make up for it through some other products, but hey, they're growing sales.
Yeah, that's important, especially with inflation coming around here too. They're going to need to keep growing sales to offset some of those increased costs and supply chain issues that are coming around. So that being said, interesting stuff happening with the brands, great news with the sales. Lanny, let's jump right into the Dividend Diplomats Dividend Stock Screener.
All right, Bert. Well, so now it's time to look at the three metrics. Obviously, as everybody knows, that first metric, the price to earnings ratio. So right now, we had to go out there to see what analysts are expecting. And based on what we were able to find, $3.08 is that earnings expectations for Unilever. Again, we're recording this on December 26th. So using the 23rd stock price, so a few days ago on that Thursday, they were trading at $52.82. So guess what, guys? We have a 17-time forward earnings, which is actually lower than Procter & Gamble and some of the other consumer goods public stocks. And I'll say that it's very, very much below what the S&P 500 currently is trading now, which is around 25 to 28 times forward earnings.
Yeah, no, I think that's a key point right there, Lanny. That is, it may seem high, especially some of the other stocks on our watch list, like Lionel Basel, which we featured earlier in the week, where their P/E ratio is in the single digits, and some of the other companies. But compared to the consumer staples, which typically do have a higher P/E ratio, that's very, very low.
And more than likely, it could be some of the analyst expectations being where they are. They might be trading lower right now because of, we'll see what they do from passing on the price hikes to the consumer or not. So obviously they get impacted quite a bit if the cost of everything goes up, including transporting all of these goods to the consumers. So again, we'll have to see how much they offset with the increase in price. So, again, it may be because it looks bearish for the consumer goods industry.
No, that's an excellent point, Lanny. The second metric here, the dividend payout ratio, it's always a little bit tricky here doing an international dividend here because different sites will convert it differently. So we're going to use $2.03 for their annual dividend, which we're on Google Finance and Seeking Alpha. For that, divide that by the 308 earnings estimate. That gives you a payout ratio of 65%. So just a hair above our 60%. So not below, not overall concern though, because it's plenty of room in there between 100%, which is the part where we would get concerned. Your earnings always have to be able to cover your dividend in the long run. It is not sustainable if your dividend exceeds your earnings for a long period of time.
Exactly. And they've been more than likely at this payout ratio for some time. Obviously, again, it's hard to always gauge with the international pair with Unilever. Everybody knows that that's my biggest pet peeve right now when investing into international based stocks. But to get into that third dividend diplomat stock metric, dividend growth, take a step back, to get into the dividend growth because they're an international pair. If you look at Seeking Alpha, which really look at the max graph, the graph shows an upward trend to Unilever's dividend. So just know that their dividend over time has gone up, even if it's hard because of currency translation, obviously always changing, as well as, just how much they announce every time or every quarter. But, Unilever right now technically has increased their dividend, I believe, for over 40 plus years. And that average dividend growth rate is somewhere around that 7 to 8% mark. Obviously, some years are different than others, but again, very solid when it comes to those metrics.
Yeah, so let's move into that bonus metric now, the dividend yield. With that annual dividend of $2.03 at the current stock price, that gives you a dividend yield of 3.84%. So they're almost yielding 4% there, which is huge for a consumer staple. So you take that 3.84%, you add in a nearly 8% dividend growth rate on average, very solid dividend factor for a consumer staple giant.
Yeah, again, if you're looking for a great beginner stock right now, if you're just starting out in your investing journey, you like the consumer good brands, Unilever, again, looking at the 3 stock metric, it looks like a very good stock. Plus you get an above average current dividend yield. And on top of that, the stock price obviously is really trailing the S&P 500 here. So yeah, the stock price is down actually year to date, almost 13%. So again, keep that in mind. 2021 has not been favorable for Unilever.
Yeah, so here, let's summarize Unilever before we get into our final thoughts about the company. PE ratio 17, payout ratio nearly 66%. Dividend growth is trending upwards. You've seen some places how they are a dividend aristocrat. A 5-year growth rate of 7.69%, a yield of 3.84%, and they are down over 12% year to date.
Guys, what I want to know is, are you showing Unilever some love this year? I mean, they've gotten beaten up. Obviously, Bert's been buying them. We've owned a lot in my wife's stock personally. We haven't bought in a long time, but they consistently trade in that low $50 mark. It's kind of like, you look at Verizon stock, it trades 52 to 55 almost every freaking day. And Unilever is literally the same, that 49 to 55 kind of trade point. So have you been loading up on Unilever? Do you think this is a stock to buy? Bert, when is the last time you purchased Unilever stock?
Probably about 2 to 3 weeks ago, but I'm definitely going to be adding some shares to my wife here, and especially as I get ready to gear up for my annual Roth contribution as well. This might be a good one to throw into a Roth too and build a position there. So it's interesting. I like them at these metrics. I think they're great. And you hit it on the head earlier. In my opinion, a great beginner stock for somebody that's looking to build a portfolio, that wants to get on the dividend investing train, that wants to build something that they can see and feel every day. Unilever is a great company for that.
Bert's just riding on that dividend train, baby. Bert walks into the office and just starts doing this.
All right, the Godfather's rolling in here.
Yeah, the dividend father. It's the diplomat father's rolling in. But again,
everyone, let us know your thoughts on Unilever here. How are you feeling about the company? Would you consider building an entry position in this company, or are you going to keep building to your position over the next few weeks?
Yeah, let us know in the comments. Again, we appreciate everybody's support here. Subscribe to the channel if you haven't. Smash the heck out of that thumb. It takes about 3 seconds. And, obviously, the more that you help us, the more that we can spread the news to the investing community out there, really hopefully helping others on their investment journey. But again, that was Bert the Hurt and Lanny from the Dividend Diplomats. Over and out.